Hi everyone, I'm Mani, the CEO and founder of Valor. If you have or are planning to sell appreciated capital gains assets in Arizona, you know you'll lose something between federal and Arizona taxes. But the big question is, how much will you lose and what can you do to reduce your taxes? It's important to understand your capital gains taxes and how they will impact your financial future, not least because that knowledge will empower you to take action to reduce your tax bill today. In this video, we'll explain what capital gains are and how they are taxed in Arizona. We'll also show you different tax planning strategies that can significantly reduce your capital gain taxes and help you build wealth faster. These strategies range from selling appreciated assets in a tax-exempt structure through charitable remainder trusts to purchasing renewable energy projects, utilizing exchange funds, and exploring qualified opportunity zone funds. So, let's get started. What are capital gains? Capital gains are an asset's increase in value above its basis, or in other words, cost. Assets can include stocks, real estate, or even an item purchased for personal use like a car or a boat. Basis is usually the price at which an asset was purchased, but for some assets it might be a different amount. For example, if you renovate your house, your basis in the house will be the purchase price plus the money you spent on the renovations. Capital gains can be realized or unrealized. Realized in this context means acquired or received, so realized capital gains are gains that you have received from selling the asset. Unrealized gains, by contrast, represent a change in the value of an investment that you have not yet sold. Capital gains are not taxed until they are realized, meaning that even if your Apple stock has increased 50 times from the day you invested, you won't owe any capital gains taxes until you sell the stock. There are two types of realized capital gains for taxation purposes. Short-term capital gains are gains from selling assets that you've held for 1 year or less, while long-term capital gains are gains from assets held more than a year. Realized capital gains are typically subject to both federal and state taxes. The tax rate you will pay on capital gains will vary depending on where you live, your income, and the type of asset you sold. For federal capital gains taxes, short and long-term capital gains are taxed differently. Short-term capital gains are assets held for 1 year or less before being sold, are taxed as ordinary income, while long-term capital gains are taxed at lower rates. In 2025, federal short-term capital gains vary between 10 and 37%, while federal long-term capital gains, which are also progressive, range from 0 to 20%. What about Arizona capital gains taxes? In 2025, Arizona taxes capital gains as income, and both are taxed at the same rate of 2.5%. Moreover, Arizona also provides a 25% deduction for long-term capital gains. So, what would these numbers look like in the real world? Let's consider Jenna, an investor who purchased 7,000 shares of Apple stock in April 2019 at $50 per share. She decided to sell her shares in January 2025 at a price of $100 each. Jenna held the stock for more than 1 year, so her realized gains are considered long-term capital gains. She paid for 7,000 shares at $50 each for a total of $350,000 and then sold them for $100 each for a total of $700,000. That's a net gain of $350,000. She would pay a total of around $52,500 in federal long-term capital gains taxes for 2025, an effective federal tax rate of around 15%. Jenna would also pay Arizona taxes on her capital gains for around $6,562. Or an effective state tax rate of around 2.5%. As you can see, capital gains taxes are a common burden that can significantly reduce your net earnings from the sale of an asset. Accordingly, it is critical to identify strategies that can reduce these taxes. Tax planning is a strategic approach designed to reduce a person's or a company's tax liability by leveraging various tax benefits and allowances. If you want to compare these strategies based on your own inputs to see which one suits you best, you can do so by using our free comparison calculator. Here are the 4 options you can consider. First, use a charitable remainder trust. This is a fit for people who are selling appreciated assets, want to use the proceeds for their own benefits over their life, but don't need the money immediately. A charitable remainder trust, or CRUT, is a tax-exempt structure with many tax benefits, and according to Charles Schwab, is well suited for appreciated assets you have not yet sold. In exchange for donating some of the money in the trust to a charity, You can defer the taxes you would otherwise pay when selling an asset, reinvest it tax-free inside the trust, and receive distributions from the trust for a set number of years or multiple people's lives. Plus, CRUTs give you an immediate charitable income tax deduction when you put the assets in. CRTs typically increase after-tax returns substantially when selling appreciated assets. Second, buy a renewable energy project. This is a fit for people who have already realized their capital gains and have the time to spend 100+ hours in that tax year to actively run a solar business. Purchasing renewable energy projects can make you eligible for significant government tax incentives, tax credits, and depreciation to lower your capital gains taxes. This strategy typically can return more in tax savings than your purchase price in the first year alone, and you receive more tax savings and income in future years. Third, use an exchange fund. An exchange fund is a fit for people who have appreciated assets, want to diversify but are older, and don't need to sell the assets or require liquidity for their own use. An exchange fund is similar to a mutual fund, but instead of contributing cash, investors contribute stock. By aggregating the concentrated stock positions of many investors, an exchange fund allows you to substitute or replace your own concentrated stock position with a diversified basket of stocks of the same value. Importantly, after you have exchanged your concentrated position for a diversified basket of stocks, you will still have to pay capital gains taxes when you sell the diversified stocks. Still, because you now have a diversified basket of stocks, it may be less pressing for you to sell your shares and face capital gains taxes. Lastly, opportunity zones. This structure is ideal for individuals who have already realized capital gains, seek real estate exposure, and view their potential opportunity zones as a top quartile investment. Investors with eligible realized capital gains can roll those gains into a qualified opportunity zone fund designed to develop underinvested communities. By doing so, within 180 days of realizing the gain, they can benefit from two key tax incentives: tax deferral and basis adjustment. In a qualified opportunity zone fund, capital gains may be deferred until the investment is sold or exchanged, or until the end of 2026, whichever comes first. Additionally, if the investor holds the qualified investment for at least 10 years, they become eligible for a cost basis adjustment, aligning it with the fair market value when the qualified opportunity zone investment is sold or exchanged. All right, that wraps it up. Now, a quick word about Valor. We've built a platform to give everyone access to the tax planning tools that billionaires, such as Facebook founder Mark Zuckerberg and others, use. Simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. I really hope you found this video useful. If you still have any questions, please visit our website at valor.com, where you can read more content on the subjects, use our online calculator, discover your potential financial gains, or schedule a call with us. Check the link in the bio for more details. Please feel free to comment, like, share, and subscribe to our channel. Thanks for watching.